The Rebel Capitalist Show. All right, guys, it gives me a great deal of pleasure to welcome someone back to the Rebel Capitalist Show. He is my good buddy and one of my partners in Rebel Capitalist Pro. His name is Chris MacIntosh. Chris, welcome back to the show, my friend.
It's been too long, mate. Been busy and trading messages, but not jumping on calls. So it's great to do it.
It's a crazy world, isn't it? And I've been talking a lot about, and everyone's been hearing about the Great Reset agenda and what's been happening with the cerveza sickness, and how they may be connected, and what's happening in Russia, Ukraine, and the West response with sanctions and the ruble, and maybe moving away from the petrodollar system. So what I'd like to do, and I don't know anyone who's better at investing for global macro than you are. So I know a lot of us know what the problems and kind of where the world is headed, but a lot of us have a question as to, okay, well, how do you invest for, you'll own nothing and you'll be happy type thing in 2030. So if you could start by giving us kind of what you've been thinking about the most over the last couple weeks, how you see this, what we're dealing with right now from a standpoint of the global elite, the politicians, the games they're playing, the media, and then maybe how we can set up our portfolio to take advantage of their insanity.
Yeah, there's a lot to cover, so we'll try and encapsulate it. And for anyone listening, really the thing to do is to go back and look at a lot of the videos that you've been doing over the last month or so, which really brings together a lot of the themes that you need to understand in order to kind of step forward. So if we go and we think about the last sort of major energy shock, that was when the Arabs pulled supply essentially, and at that time you didn't have a situation where there was an insufficient global supply of energy, but what there was an insufficient ability to move that supply.
This was back in the 70s, Chris?
Correct.
Yeah.
Yeah. So, and that that put things in a real spin. The global economy took a massive hit. Oil, I mean, it wasn't just oil. Energy, and of which oil is easily the largest component globally, translates into everything else. It translates into foodstuffs. It translates into the iPhone that you buy, because that's got to get transported. The components that are manufactured by it typically are brought out of the ground with diesel trucks and mining equipment and so on and so forth. So it's really kind of like largely the bedrock, if you will, of our global economy, whether we like it or not.
Yeah, a lot of people, I know a lot of people comment on my videos when I talk about gas prices going up, and they say, oh, well, I don't drive. It doesn't really affect me. I don't have a car. I'm like, no, you don't understand.
Yeah, it is the underpinning to modern civilization. It's really that simple. So if we go back and we think about that sort of scenario, what we saw there, we're having something of a similar description taking place now, except this time it is self-inflicted. That was an exogenous or an external event as a consequence of political dissatisfaction and so on and so forth. This time, what we have is something that's actually self-inflicted wound. And we can argue about whether it is by design, by the Malthusiast neo-Marxists, their intent to exert greater control over the system and of us. Whether you believe that to be the case or not actually doesn't matter, because the reality is that it is transpiring, and we have to invest and try and position accordingly. So it's like the apples falling off the tree, and we can choose to say, well, it was rotting, or the wind blew it, or whatever. It doesn't matter. It's falling off the tree. Deal with it. So that's kind of the situation that we're in today. It feels extraordinarily easy to identify what sectors we should be investing in. Part of that, it's a two-part process. One is just the physics matters and mathematics and economics matters. And for anybody that pays even the slightest amount of attention, we will see that there are shortages in certain goods and and surpluses in others. And so the other component, of course, is that there is so much that is extraordinarily overvalued as a consequence of this massive bull market in bonds that we've seen really since the 50s. And so it's meant that it's more difficult to make a case for investing in many asset classes. And so if you sort of just scrap and wipe away those that you say, well, it's not cheap, or, then there's not a whole lot that you're actually left with where you can go, okay, that makes some sense to me. So it does feel relatively easy to know what sectors we need to be invested into. What is, I think, most challenging, and is going to be something that we're just going to have to try and navigate on an ongoing basis, probably for the next decade, is more around the nuances of political and geographic, what's the word? Forces. Here's a good example. So I was on a phone call the other day with some clients of ours, and they're over in Wales. I got some real estate over there, quite a bit of real estate in Scotland and Wales, and so they've positioned themselves relatively well for dealing with an inflationary environment. They don't have a whole lot of debt on these properties. They've got good cash flow. They're in their late 60s. So they're kind of set up to be able to retire with strong income and a certain level of protection by holding assets that should, in a normal environment, at least keep pace with some inflation or an inflationary environment. Mm-hmm. The problem that they're having now is the socialists in these places are now putting in rent controls. Mm. And so what rent controls are going to do, they're going to constrict supply, obviously. Is what they do, because no logical thinking entrepreneur goes, oh, I'm going to dive into that when my income is capped. So it constricts the supply, but at the same time, it doesn't bring about additional capital into a market with constricted supply, which is your normal market mechanism, right? Because it doesn't. The entrepreneur sits there and goes, not going to do it. It doesn't make any sense.
And also, too, they let that property deteriorate. So then that reduces supply when it's deteriorated to a point where it's offline.
And the other component, of course, is if you do that at the same time that you're printing, right? You're now your income's capped at whatever it's capped at. Let's say you bought a property on a 10 cap, all right? And you go, oh, that's pretty good. I'm all right. Let's say inflation's running at 8, you say, well, I'm keeping ahead of the curve here. Well, if you're capped at your 10 and then they start inflating, it doesn't take you long before you're underwater.
Yeah, your expenses are not capped. Your income is.
Your expenses are not capped. Your income is capped. And the other component is it's difficult to get out. And so what you'll see people will do, and I've seen this if you go and you look at where this has been done in the past, often in third world countries, people in those initial phases don't want to get out because they feel like they need to get back the value of their property. Because immediately what happens is the property prices fall. And so they're like, oh, it was worth $1 million. I kind of want at least that back. Not realizing that inflation's eating away the $1 million. And in 2 years' time, it's not $1 million, it's 900 or 880 or some other real value.
Purchasing power.
Your nominal value might stay the same. So these are the challenges. I'm just giving that as one example. These are the sorts of challenges I think that are going to be much more prevalent, and really we have to try and keep our bloody beady eye on the ball to be able to navigate that, because you could easily say, fine, we're going to have this stagflationary environment. That's what we believe we're going to have, what we've been talking about for the last 3 years. If we're correct, you say, okay, we know how to navigate a stagflationary environment. We kind of know what asset classes to buy, and we can diversify and so on and so forth. But the bigger challenge is going to be these sorts of issues. is it REITs in Scotland? Well, probably not if they're going to cap rates. Sorry, if they're going to cap
Rents.
rental incomes and things of that nature. So where do we go? Oh, maybe we move across the pond. What about Germany? Or so with that component is going to become more important. We're going to see things like, there's potential profits taxes on these greedy oil and gas executives and companies that are fleecing the public. Never mind that their capex spending has collapsed for the last 10 years, and they actually don't have the reserves that they ordinarily would have going into what is now a huge energy crisis. And now you're going to hit them with maybe a 50% profits tax or some, so those sorts of things are also going to current supply. It's exactly the same kind of scenario, albeit in a different sector. So what it does do, because we've got to look at the bright side of things, George, what it does do is it actually creates more asymmetry in any participants that choose not to do that. Right? Because we know what capital does. It goes where it is best treated, wherever that may be. What I think is going to take place, and I've had some conversations over the last couple of weeks with some old trader friends from years back that I managed to start contacting from literally 20 years ago. If we look at what happened on the LME, that's an exchange. That's a dead exchange walking. What they did there really has destroyed credibility of that exchange.
Yeah.
So
Cuppy was talking about this too.
Yeah. So Cuppy's a good mate, and we chat regularly. So what happens now is everything becomes relative. If you're going to be placing large bets, as big trading houses do, you need to know that you have some security in terms of the contracts that you're putting together. That's now being destroyed. So,
Chris, can you just back up just a bit here and explain to the people that might not have followed this story what we're referring to with the LME, and then I think you're talking about basically the Russian stocks and whatnot, and how they could control, like, I think Cuppy was talking about, well, if they do this to Russian stocks, and they could also do this to, any paper gold contracts you may have as well. Can you explain that a little bit?
Yeah, so very briefly, essentially if you have volatility, if you have market disturbances on any exchange, it's not unusual for them to halt trading.
Right.
Right. In order to basically let everybody get their head and chill out a bit and kind of have the market readjust, and then they'll open it up for trading. You will have ordinarily, often, if there's a big market move, you might have some people go bust, some leveraged funds and everything else that kind of get washed out. But you can have almost like an orderly breakup. And what they did in this instance was, instead of just having some sort of orderly readjustment within the markets, was they retroactively went and canceled trades that have been placed. And you cannot do that. That is literally a breach of contract, right? And they did so in order to bail out a Chinese billionaire.
Oh, now you're talking about nickel. So okay, I thought you were talking about the Russian stocks.
So nickel. Well, look, this comes into the Russians. It's a similar dynamic.
Okay.
The point behind all of this, so these look, a lot of this is kind of like the specifics of what's taking place in maybe on the LME or with the Russian stocks. If you step back and you look at this from a 40,000 foot view and you say, okay, what is actually going on here? Why are we having all of these little things taking place? What we're kind of seeing is an attack at the very bedrock of Western civilization and what has been built in terms of our infrastructure, our legal infrastructure, the institutions that we've entrusted our capital towards, for custodians, for trustees, for exchanges, and all of the legal infrastructure that holds those together. That is all under attack,
right,
in multiple different avenues. And you know, you could put your tinfoil hat on, you could run down the rabbit hole of the World Economic Forum and the various Hegelian dialectic type of strategies. But again, we don't need to even do that. It is happening, whether it is by chance or whether it is by design, doesn't really matter. You still have to deal with it. And so what happens there is human beings being so flexible and adaptive, we will find different means to solve our problems. What I think is, and I'm seeing this to a certain extent already, is we're going to see a lot of this trade start actually shifting to, and I hate to say it, a place like Shanghai, which is picking up increasing levels and volumes of commodity trades, partly just by the fact that China is a huge commodity consuming country because it's the world's factory. And so long as they don't inflict the same sort of damage, if you will, on market participants on their exchanges, that's where the capitalist is going to go to. You know, you can set aside your moralistic, ethical views of the CCP. That's just a reality. That's what is taking place and what I think is going to probably accelerate so long as the alternatives are under attack. And so coming back to the discussion that we had before, which is how do you invest in this sort of environment? It's not just looking at the sectors. You've got to look at those sectors. Like I said, it feels relatively easy to know in which sectors we need to be invested into. Certainly it's easy to know which not to be invested into. If we've got a food crisis coming, we know we can't eat JPEGs. So I'm not going to be investing in NFTs or something like that. But that the geographical location of assets and the underlying legal security of those assets, and those are all impacted by geopolitical realities. And so we've got to pay a lot of attention to that. You know, we're seeing these negotiations and arrangements being put in place now at warp speed with countries like Russia and India, with China and Russia, with
Saudi Arabia,
Iran and China, and you know, and it's fascinating because we've been talking and writing about this for over 2 years now. These new alliances that always get built under times of economic pressure and hardship, because if you think about how we are as humans when we're under pressure, physically, psychologically, financially, we'll normally retreat initially to a place of safety. So if you, for most of your listeners, they're probably Americans, so they'd know, and we can, we know that within the United States, there's a huge movement of people from often blue states to red. Florida's had one of the largest influxes of people in the last decade. Why? Well, we know why. So to a certain extent, that's people also, it's not just looking for a better life, but it's also retreating to safety, relative safety. And so what you do once you've actually got there, if you're then still attacked, once you're in a place of safety, you defend what your core values are, what it is that you hold dear. So that's happening in the United States now, but it's also on a global basis going to take place, where no man is an island. So you can't, just as no country is sort of an island. You take Japan, they don't have energy security, so they have to, even if they are xenophobic, which they are, they still have to solve their energy problem. So they still will need alliances of some description in order to secure their own system, their own governance, their own political security, and so on and so forth. And so you'll see that it's no surprise that they've had some fairly substantial deals that they've done with Indonesia for coal. in order to secure supplies. And so these sorts of alliances will continue to be the pressure that's being built and put in place now is going to accelerate those. And so we're seeing that, and the world's bifurcating into, I would say, it largely looks to me like deficit and credits of countries. I mean, if you think about like the wages in the US that exist, they largely exist really as a consequence of dollar supremacy, because manufacturing has been declining for decades, and much of the Western world and the United States in particular has become financialized. That's why there's so many business schools. If you just look at the university education, Asia is pretty much pumping out engineers and scientists, and the West is pumping out business execs, and now increasingly, people with sociology degrees and gender studies and things of this description.
Yeah. So let me just kind of explain that really quick. So what happens, guys, after Bretton Woods is the United States dollar becomes a world reserve currency. The problem there, Triffin's paradox, if you will, or dilemma, is the U.S. is now in charge of supplying the world with those dollars. Well, how do you do that? In order to get the dollars from the United States outside into the global economy, you have to run a trade deficit. And so if you run a trade deficit, that means that you need to, you manufacture less and less and less and less in the United States, and you offshore that manufacturing to more and more countries. Therefore, they are producing the stuff, they're exporting it to the United States, we import it, and then we export those green pieces of paper. And that's been happening since the 1950s. Well, I mean, you could take back to 44, but really substantially since the 1950s. And then we see this globalization process over the last, call it 20, 30 years, that's really kicked that into high gear to a point now where the United States is running the largest trade deficits in history. And the manufacturing, I would argue, here in the United States is at its lowest in history, regardless of what stats you want to look at. The bottom line is we produce a lot less stuff than we used to. We're producing less and less stuff every single year, but yet we are consuming more and more and more. The fact that we are consuming more than we produce means that we are manufacturing less and they are manufacturing more. So that's kind of what gets you up to speed as to what Chris is referring to.
It's a fantastic little synopsis of it. And it leads into the next thing that is, I think, is worth talking about, which is those savings, those excess savings from credits to nations have gone back into financing that deficit. And it's worked. I mean, it's like anything, it works until it doesn't.
Yeah, meaning they buy treasuries with their reserves, and then that keeps the interest rate down on the treasury. It keeps the interest rate low domestically, which allows us to consume more than we produce.
And at the same time, it allows for their own wage inflation to remain somewhat suppressed. And it allows them to be competitive, continuously competitive in that current structure. That is all now being destroyed.
Yeah.
And the repercussions of it are enormous. They're epic. It's I mean, I've got a whiteboard in my office next door, which I took the call in this room because my office is being stripped to get painted, so it looks like it's in a bomb zone. But anyways, and I've got, I've been mapping all the stuff out, and when you run through all the various kind of components and those second and third order consequences, it is just unbelievable.
Yeah, right.
I mean, the fact is that we've had this, you mentioned offshoring, George. If you think about, I don't know, like, we're of similar age. I think we're like 5 years apart. I still remember growing up where you'd go to the dentist, and the dentist did everything. They cleaned your teeth, they filled your holes, they did everything. One person. Like, you go to the dentist now, and there's like 3 different people. There's someone who cleans your teeth, and then there's a dental hygienist, and then there's the dentist, and then there's an orthodontist who does other special bits and pieces, and everything has become more specialized and more outsourced. which brings with it higher productivity. Okay. But with the higher productivity, you lose resilience.
Right.
So we have this extraordinarily, we've kind of reached, I would say, peak productivity in terms of our ability to outsource more and more. It's the just-in-time inventory system. Yeah.
Yeah.
You're running a shop and you're like, oh, I'll get it down to 2 days. If I can get it down to 1, I might shave another 2 points off of my OPEX, right? That hits my bottom line. Let's go. And you'll keep doing that until you have some exogenous event that just cocks you up and suddenly you don't have supplies on your shelves for a week. And that blows out that 2% increased margin that you were counting on. Now it's gone because it's wiped out because you couldn't sell any goods.
And Chris, the flip side of that coin, because you're looking at it from a standpoint of the importer of goods, i.e. the United States, but if you look at it from the exporter, the country that's running the trade surplus, you got to look at their end of the bargain, and that's that they get the reserve asset that is a long-dated dollar. And so we're looking at this saying, wait a minute, this isn't a very good idea because we've got a lot of counterparty risk. And they're looking at this, China specifically, and I'm referencing my discussion with Luke Groman, our good buddy. And he points out very well that China's like, okay, we're producing all this stuff because we need to buy energy in the future. But the what we're getting for producing all this stuff, which would be dollars or treasuries, we're going to be able to buy a lot less of that in the future, a lot less oil, a lot less energy, because the Fed is keeping rates, at negative, or real rates, let's say, at -8 or 9, 10%. Who knows what the real rate actually is? And therefore, we also have just as much counterparty risk as the United States does. It's just in a different format. We have counterparty risk in the fact that they supply us with all our stuff, and they have counterparty risk. And from a standpoint of everything they're getting for supplying that stuff, we have certain control over the purchasing power.
And that's before they went and stole Russia's reserve assets.
Exactly. Now you really realize the counterparty risk.
And so, it's not just what you hold, because part of what we're discussing there is this flow of capital, right? And you're saying, well, I kind of got to keep my business going. If it's a country, kind of keeping your business going. And you got this setup where you're investing in these treasuries, your surplus in the treasuries, keeping exports going, and so on and so forth. But now you've also got to look at it's your income statement and your balance sheet, right? So on your balance sheet, you've got all of these surplus treasuries, which just got stolen from Russia. Okay, stolen, frozen, call it what you will. Now, it is impossible for other countries to not look at that and say, do we maybe just not save as much in treasuries?
Exactly.
Even if they don't have to dishoard, they don't have to sell. All they need to do, there's about 900 billion a year that needs to go into treasuries. So from credits and nations, all they need to do is just curtail some of those purchases and put it into something else. The question then is, what is the something else? I would suggest it's gold.
Yeah, that's what Luke
I think it's, and so that whole dynamic, and then there's a feedback loop that takes place with it, right? Because as more people do it, it accelerates the trend. And look, we're at the tipping point where this is such a precarious house of cards that I'm not sure you can deleverage and de-escalate that without serious second order consequences. This is without looking at canceling what is the world's largest energy producer. You cannot cancel the world's largest energy producer and not have some serious financial repercussions to that.
And I just did a story today too on how Russia, last week they came out and said, well, okay, we're going to price some of our natural gas in rubles. But this week, just as of today, it's Wednesday today, I believe the 29th or the 30th, something like that. They came out and said that they could price all commodities So not just natural gas, but that would include oil, that would include fertilizer, that would include timber, that would include everything else that they produce that the world really depends on for energy and food. Really, the two most, you can have all the gold and Bitcoin and real estate and dollars that you want. If you don't have food and energy, you got big problems. And people say, oh, well, that's not that big of a deal because Russia supplies X amount, let's say like, 20% of the potash, but they don't realize that the price is really determined at the margin because you're dealing with very inelastic demand.
There's two things. Price is always determined at the margin, but additionally, it comes back to what we were talking about before, this highly financialized, highly globalized economy whereby everything has been outsourced in just-in-time inventory and so on and so forth. The supply chains are so important for bringing any produce to market that even small disruptions in them can change that margin. And we're not seeing small disruptions, we're seeing extraordinarily large disruptions. So for example, so Ukraine produces 90% of the neon in the world. Neon is utilized in semiconductors. Semiconductor shortages now, which are mostly produced in Taiwan, are causing impacts in farmers in Brazil. I read it.
Because they can't get their tractors. Their tractors won't work without the semiconductors.
So you've got a farmer in Brazil that's not going to plow his crop, or he's not going to harvest his crop, or whatever the case might be. A certain amount of supply comes off the market there, as a consequence of this chain of events. So what we are going to move to by sheer necessity are more resilience, a requirement and a need for more resilience, which is going to be offshoring goes away, it becomes onshoring, but that's going to be a more painful experience for the countries that are financialized.
Right.
It'll be less, all things being equal, which they're not, but all things being equal, those countries that have not offshored to the extent that others have, that have not financialized to that extent, are in a somewhat better or more resilient position in order to move forward. And then the second step that takes place ordinarily, and you look in history, this is what we do as humans, is we build alliances, right? You go, shit, I can't do this myself. I haven't got the capabilities, but I do have what I have here. I can do X, Y, Z, and my neighbor over there can do, ABC. Let's get together. And so that happens on a macro basis. And so we're seeing a lot of that taking place. Turkey is a huge manufacturing country, but they're short in energy.
Okay. Yeah, which is why they're hyperinflating the lira.
Which is partly why they're hyperinflating the lira, apart from the fact that Iran is not the smartest, sort of sharpest tool in the shed, but never mind. But there's just a geopolitical reality there that they will need to source and secure energy. They're going to have to. And so even while Turkey has been looking to join the EU, largely as a consequence of many other reasons, most of which are just trying to extract more money out of them because they've done extraordinarily well in NATO with that respect. But the reality is that's not going to happen. They know that they're not going to get the energy from Western Europe. They're not going to come from the EU, who are a net importer of energy. So there's where's the relationship? When the pressure's on, the relationship changes. And so their alliances will look elsewhere. It'll be Iran, it'll be Russia, it'll be Saudi Arabia, it'll be somewhere else. And so these sorts of alliances they're being shaped and formed now. And so back to the question at hand, which is how do you invest in this world? It's paying strong attention to that, because there is an extraordinary symmetry again in if there's no energy, say in Western Europe, and they're clamping down on it and they're trying to push, the road to zero and all this nonsense they keep talking about.
Oh yeah, to 2050 net, the carbon net zero thing.
Yeah. Yeah. So the more they push towards that, the higher the price of the underlying asset that they're constricting goes to. And people, even within those like within the EU, are going to seek alternatives because they're going to have to. What's going to be interesting, because Russia's basically, for example, said, look, we're going to turn off your gas unless you pay us in rubles. Macron came out, I think it was yesterday, and said, no, we're not going to pay you in rubles. So, and Hungary turned around and said, yeah, we will. So what's going to be interesting is when Hungary's got energy and France doesn't, okay?
Yeah, but you know what's going to happen there is France is just going to buy their energy from Hungary.
Either that and all.
Look, it's just a workaround.
This is the beginning of the end of the EU. It cannot hold together because what will happen is von der Leyen and all these clowns sitting in Brussels, drinking their Perrier and eating their caviar, are going to say, no, Hungary, you're not allowed to do that. And we're now putting in some legislature and blah, blah, blah. And Hungary is going to turn around and say, niet. And so then of course, they're going to do similar to what they did to Poland. And they're going to say, well, we're not going to give you the funds that we promised you in terms of our budgets and da, 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 da. Because remember, the point is, what's made the EU so successful, quote unquote successful, is the fact that they've centralized the banking to the extent where they have control over the banking in each individual country, and they provide liquidity or not to the banking systems. And so that's an extraordinary tool, and they're going to probably utilize that. But again, it's meeting these pressures of, well, freezing for one. And so I can see that just building, and it's going to fracture and bifurcate, and you're going to have certain countries that just go a certain way and other ones that don't. And in that environment, it creates more asymmetry, much, much more asymmetry than we would ever have had, like in my career. I mean, I've just never had to deal with this sort of
yeah, you know, on that geopolitical note, people have to realize that in the West, the politicians are doing this balancing act that I think we will see more of in the future. And so when you're talking about different countries to invest or stay away from, I think you've got to think through what the incentives are for the politicians that are involved. So as an example, today, Germany announced that they would not pay for natural gas in rubles. Therefore, they're going to consider just restricting supply or rationing gasoline and rationing energy. Okay, well, we know, like we said earlier, that energy is the economy. So if you're rationing energy, then you are decreasing economic output, GDP, voluntarily. And if you're reducing GDP, you're reducing the standard of living. Bottom line, period, there's no way of getting around that. So what they're doing is, on one hand, they're trying to be woke, and they're trying to be green and ESG and all these things because they know their voters want that, or the majority of their constituents, let's say, want that. And then on the other hand, they're going to have to battle and deal with the standard of living going down further and further and further, and less economic activity. So it's like, where do they get that to that tipping point, right? And you have to understand that if you're an investor, and let's say you're considering investing in Germany right now, you've got to realize that you're putting capital to work in an area where the politicians are voluntarily choosing to be woke at the expense of lowering the standard of living and the economic output in their country. And so
they're making up the shortfall by printing stimmy checks.
Yeah, right. And for people who aren't following that, who don't really understand inflation, I can tell you this very simply, that in the solution for inflation is not more money. It is more stuff. If you try to solve an inflation problem with more money, you're just going to exacerbate the problem.
Absolutely. The other side that I think this goes kind of exponential in both ways. And what I mean by that is they'll use this crisis to actually bring about a lot of Malthusian
Totally agree.
Marxist central planning ideas. It'll be UBI, it'll be seizure of assets in some shape or form. And while that's because when these pressures come, when the productivity collapses, and it will, it's impossible for it to not. Those deficit countries become massive deficit countries, right? Because their productivity, the GDP is just collapsing on the back of debts that it's like, here's your balance sheet, here's your income, and your income's just going, and your debt levels are still exploding higher, and you're trying to make that up by printing more money. And that's where we're going to go into. And I wrote about this in February of 2020. And I said, what is most probable? And look, this is crystal balls. I've got two balls and they're not crystal, but this makes sense. They will use they will use this as an excuse to default on domestic debt. They can't necessarily default on international debt because that's war, okay? Or could quite easily lead to war. And ordinarily I'd say, well, they wouldn't do that. Now I'm not so sure, but never mind. And they will use that as an ability to say, you know what, the pensions that we promised you and the social health care and all of these obligations that exist, it's not our fault. It was the
Putin's fault,
COVID,
It's Putin's
and then
fault.
it was Ukraine, and then it was Russian hackers. When they come out with their next shutting down of
it's the greedy capitalists. It's Putin. It's all the usual suspects.
So it's again, this creates more asymmetry because what the smart money is already looking at this in Europe, and it is moving to places that are deemed to be less risky. Okay, so a lot of capital is shifting out of Western Europe, out of Germany, out of the UK, and you're seeing it in human capital too. Next week, I'm shooting over to Dubai. Eventually, I can get out and back in and stuff. Apart from Russians, places being flooded, but this has been in process for at least 18 months, 2 years now, is Westerners leaving, going there because they know that the taxes are going to go up higher. And those who are smart enough realize that it's not just a tax problem. They're actually going to come and they're going to seize and take assets because they've told us that's what they want to do. You've done some fantastic work red pilling people with respect to the World Economic Forum. And I mean, they tell us, I spent probably maybe over 6 months ago, I sat down and I spent at least a week. And all I did was I just read through IMF documentation and World Economic Forum and stuff. It's like all I did. It's really enlightening. I mean, it's not most people's cup of tea for a bedtime reading, but they tell you exactly what they think and what they want to do, and they're implementing it. And so it's actually foolish to sit there and say, well, that's not going to happen. It's like, it might not happen, but it only might not happen if someone pushes back because they're in control and they're busy doing it. And so when you look at that structure, a debt repudiation, can you imagine a debt repudiation in any of the G7? What does that do to capital that previously thought, it's kind of okay here? Right. It wakes up really quickly and it searches for a home somewhere, anywhere. And so, what we've really been trying to do is trying to identify the probabilities where that might be, and not taking one bet, because it's such a volatile geopolitical environment, but to at least be abreast of those risks. And again, it comes back to, I think, those creditor detonations. The creditor nations don't have, maybe they want to, but just because it gives you more control of the citizenry, but they don't have to. They're not in a financial bind where their solution to retain control is predicated on them bringing about a debt repudiation or something of that description. And so again, your probabilities are just that much better. Where you are in Colombia, I think you're still in Colombia.
Yeah.
Slightly better situation because domestically, your LVRs on residential real estate are much, much lower than they are in the Western world. And so the ability to actually use that debt component to have like we're sorry, but we have to do this sort of thing, and to seize those assets in some shape or form is just A, it's not required as much, and B, it's not as easy to do because your citizenry are like, well, you can wipe out the debt, we don't have any, or my mortgage is to Auntie Cindy down the road, and I only owe her like 20% of the value of the property, and so it's a different kind of economic structure. I'm just using real estate as an example, but that's true, globally, and I think that's the probabilities of that are much, much better in these creditor countries, and hence there are also these countries which don't have the requirement or the incentives to actually bring about freezing of assets to impact to do what they did on the LME, for example. And so as a consequence, I think that's where you need to be investing your capital. Within those sectors that we previously discussed. Like I said, it feels kind of obvious as to where we need to be invested in terms of sectors. And I think now most of the guys that we consider to be good investors and reputable and whose opinions we value, we're pretty much all on the same page. You talk about Kapi and Luke, and I mean, like there's nuances around it, but like we're pretty much all like, no, yeah, okay.
Yeah, even Brent, Lynn, I mean, everybody, really.
It's so obvious now.
Yeah, so let's go back to that, because you started talking about commodities really when I first met you in 2020, and when we really started Rebel Capitalist Pro together. And back then, everyone was kind of not really laughing at it, but I don't know that they were taking you that seriously. You were saying, and I remember this distinctly, how you were saying that we're going to have food shortages. We just are. It's just a mathematical certainty, and we're going to have shortages in all of these commodities. Now, I want to remind you that Chris was saying that back in 2020, right before and during the cerveza sickness and the lockdowns, when commodities absolutely crashed. And when oil got down to what, negative $38 a barrel, you were pounding the table, pounding the table and saying, and in fact, you were the one that introduced me to the idea of coal as well. I talk about that a lot, and I need to give you all the credit there. And you were pounding the table saying, hey guys, what the global elite are doing here, and this movement towards ESG and this Malthusian movement towards reducing the level of consumption under the guise of climate change or whatever, carbon neutral, whatever, 2050. This is going to result in a situation where the cure for high prices in commodities is no longer high prices. Because regardless of the price, there's still not going to be any investment that's pulled in because it's politically incorrect. And again, this was back in 2020. Then since that time, of course, we've seen commodity prices explode higher. You absolutely nailed it. But now what we're seeing is with Russia, Ukraine, and the politicians' response to this, they are just making that problem far, far worse than I could have ever imagined. I'm sure probably even worse than you could have ever imagined. So now as investors, I know I'm at a point where I believe we're at the beginning stages of a commodity super cycle. And I think that super cycle started back in March, April of 2020. And I think it's going to be a similar super cycle to the one that started in 1996 or 1998 and went to call it 2011. I just listened to re-listened to Jim Rogers' book, Hot Commodities, that I believe he wrote in 2002, 2003. I know it first came out in 2004. And he was talking about, pretty much the exact same things you were talking about and the same dynamics back in 2020. And so I went back and did some research and saw that these super cycles last about 20, or excuse me, maybe 10, 15 years. And so, but they don't go up in a straight line. There's massive amounts of volatility right there. So I guess my question is, do you think that we're in a similar super cycle that started in 2020, just like we saw from 96 to 2011 that Jim Rogers called perfectly? And if so, how long do you think that lasts? And if you haven't bought yet, when's a good time to buy? Because these commodity prices have absolutely skyrocketed over the last, couple months.
The short answer is yes, in terms of a commodity super cycle. The long answer is it's a little bit more exacerbated this time around. Previous commodity super cycles have not been associated with or in conjunction with a super cycle, a long debt super cycle that's ending. That in itself, if we just took away the whole commodity spectrum or the whole commodity dynamic, whether it's supply demand, let's just say it was fine. Even in an environment where your debt super cycle ends, you still want to be in commodities. If you go back and you look at like roughly every 100 years, those environments, because look, debt, sovereign debt is just long dated currency. It's really all it is.
Right.
Okay, so when you have a currency collapsing, you want to own stuff. It's just that simple. Because in nominal terms, at least, it's going to just go up. You could have, say, in real terms, it might actually go down a little bit, but it'll go down much less than if you were in the bonds or the currency. Right. So you might have an excess supply of sheep, right? But you're still better off owning the sheep than you are in owning the currency, right? Because the currency is being devalued faster than the productivity of the supply of sheep is being increased. So, and that's massive. That is a huge debt super cycle that's ending. So I think we've got a couple of things taking place which we've just not had before in a previous commodity super cycle, which again, I believe we have. It's that, and then it's this geopolitical fracturing that I mentioned, because previously we've had capitalism allowing or being allowed to solve the problems. This
high
time,
prices, right?
With high prices. This time it's not. They're literally canceling supply and then handing out stimmy checks. And Kapi nailed this a few months back, and he said, yeah, this is going to be awesome, because what they're going to do is they're going to keep their woke ideology because they're anchored to it like you're anchored to a religion.
Right.
And then they're going to give stimmy checks when people cry and bitch and moan. And it's like, that's the best environment for energy. I mean, you couldn't find a possibly better environment for the underlying price of the commodity. Yeah. So all of that, I think, is true. And again, I come back to, this is where capital shifts to places of relative, where it's relatively better. So the countries that decide, no, we're not like carbon neutral by 2030, either goes to carbon neutral by 2060, or it just goes to carbon fuck off. And and so, it's like I like to say, everybody's a greenie until it hurts their pocket, and that's kind of the reality.
Yeah.
Right. So that's where I think we go, and the world really splits into
kind of east and west again. You got Russia, China, India, Saudi Arabia, maybe Brazil, and then you've got the woke West, we'll call it. And I just, when you're talking about those alliances, I'm thinking through, the U.S. dependency on China. And I know they say, well, China's really dependent on the United States for the dollars they need. I totally get that it's a two-way relationship, but just imagine what would happen to the U.S. consumer if they could no longer buy stuff from China when they went to Walmart, Target, Home Depot. All the stuff from China was no longer there, and you had to source that stuff from one of the countries that you aligned with in Western society, meaning at $20 an hour. I mean,
Yeah,
That gets
your
really,
middle
really
class,
ugly fast.
just gets destroyed in a
Done.
heartbeat.
Yeah, that's right.
Um, and that's where those realities, then we're going to see, I think, if you think of the West almost as a block, it's going to fracture internally. If you like, think of a sports team. It's been winning. Everybody's happy. And you can have Joey who's maybe he's not that good, right? But everybody likes Joey because he's a bloody hoot in the locker room, and he's whatever. Everything's fine until you start losing games. And then you lose more games, and you lose, and then we've got to get rid of Joey. He's the reason. And it's just what happens where human nature doesn't change. And so that's going to happen, I think, domestically. You're already seeing that it's a balkanization. We're already seeing that balkanization forming in the United States on a state level basis. And you're going to see the same thing in Western Europe. Separatism is going to become a huge thing. Catalonia, you're going to have Scotland, Wales, like all of the stuff that people are just going to lose their minds, and they're going to look for alternatives where which give them some out from this economic pain and suffering.
But in that world, the people or the countries with most leverage are the ones that produce the most energy and food.
Absolutely. So they've both and interestingly, if you go and you look at a lot of those countries, they're actually psychologically better positioned to deal with hardship. Where you are in Colombia, they know what hardship is.
Yeah.
They've dealt with it. And so when it comes, they don't tear themselves apart because they've dealt with it. Then they have the mental and the physical skill set to actually deal with it much better.
They've literally structured their entire life around it, Chris. Yeah. I mean, I'm just, as an example, the gal out here who manages all, my just my day-to-day stuff. Her name is Kayla. She fled Venezuela to come here. And, when they came, there was probably 8 or 10 of them that came as a group, and they had zero, they had nothing. And even in Venezuela, they were pretty poor, but they had to get out of there for obvious reasons. They came here, and the way they've set up their life is they all live together in a very, I mean, maybe a 600 square foot, or not, probably 600-700 square foot apartment. And they live in a very kind of poor area. We call it a strata 1 here in Colombia, because they break the neighborhoods down by strata. Strata 6 is the best, strata 1's the worst. And, they do all their cleaning of their clothes. They do it by hand. She was actually able to buy a washer the other day because of, the money she's made with me, which that was the first washing machine she's ever owned. But they, didn't buy a dryer, just bought the washing machine so they could wash the clothes for the entire 8 or 10 people, or however many people, are living in this space. And so just using an example of the lockdowns with the cerveza sickness, they weathered that very easily because all they really needed was just rice, quite literally rice and beans. And it wasn't that much different from how they typically operate. And I think that's just a great example of what you're talking about.
The way that I think, as a Russian friend of mine, Dmitry, who said this to me, he said, you know what, with this coming problems, the West is going to fall off the 10th story. He says, in Russia, we fall off the first story. And,
great way to say it.
So like you maybe break an ankle, but you're all right. You fall off the 10th story, like some of you die.
Yeah, right.
So I thought it was quite an apt analogy.
So give the investors, Chris, some tips as to if they're bullish on commodities, where can they express that bet in an area that, from a standpoint of jurisdiction, and let me be clear, we may say, hey, Dubai might be more safe in the future, but every place has risk right now. It's just in the past, the West had very little risk. And now the level of risk is catching up to the level of risk in China, as an example.
Yes.
And in the next 5 years, it most likely will exceed the amount of risk to capital that is currently in China or in a place like Dubai. So looking at the world through that lens that you just described, how do you invest in commodities?
It's a, you did a great little sort of skip there. Risk, I think, goes up everywhere. It's inescapable.
Right.
And so that means that you've got to be diversified. In previous lives I've lived, I've had times where I've been really not diversified at all. Like I've gone balls to the wall on one particular place, sector, et cetera, and it's worked out fantastically. That might transpire. I think it's a very bad strategy in this current environment that we're in, because things can change on a dime really quickly. Russia is a perfect example, and we were long Russia. We had roughly 10% of our weighting in Russian equities, and essentially all those GDRs went to zero. But our portfolio's up. So how do we manage that? Well, one of our kind of mandates that we have in the funds we run is that we don't take on more than roughly a 10% exposure on like a sector-wide basis. And then that exposure, we diversify down into multiple equities across different geographies and everything else. So it's not like, and it's not diversification just for diversification's sake. It's looking at each of the particular equities that you're buying. Some of them will have a different risk profile. So some companies have got leverage. Now, this is stepping out of the whole geopolitical kind of
that's what makes
problems.
it so complex. Is you got to diversify not only from a standpoint of the asset class, but the jurisdictional risk.
Jurisdictional. The company, because you can't equate you can't equate a developing gold company to Yamana Gold. They're not the same. You
Right.
can't go, oh, well, there's a gold company, there's another one. I'll put 1% in there and 1% in there. No, it's retarded. So because the one has much different risk profiles in terms of what they're doing. So and then also, then you could look at it and you go, okay, maybe this one gold company, they're based in Peru. Okay, Peru's somewhat socialist, so you got that political risk there. And then you might buy another gold big producer, and it's got 15 different assets globally, some in Indonesia, some in Namibia. Like, that's a better play, at least from the risk profile, right? It doesn't mean that you don't buy this one here. It means that you understand what you're buying and you weight it accordingly in your portfolio.
Right.
And then that's in gold. So now you've got, let's say, a 10% weighting in gold equities, but they're all diversified. And then you go into the next level, and maybe you're doing agriculture. So we bought a lot of fertilizer stocks, same sort of thing. So, like, I'm not going to give tips on particular equities, because then I risk saying, and I'm not trying to be a dick about it, but that's not the way to think about it. Right. There's no stock tip that's going to make you $1 billion. Like, forget about that. We're past, like, and I know that works for some publications or whatever, but it's garbage. So you've got to think about it from a portfolio management perspective. Look at the geographies, understand what equities you're buying, where they're located, what their risks are on that geopolitical spectrum. And then of course the normal stuff, do they have a good balance sheet? Do they have a lot of debt? Are they maybe going to go bankrupt because they're running out of cash? Whatever the case might be. And we'll take risk. Our business isn't taking risk. So it's not a matter of saying, oh, that's got too much leverage. We'll buy companies with leverage for the very fact they have leverage, right? Because when things go well for us, that's the stuff that goes up 10, 20 times. And of course, you're always going to go, wow, I wish I had like 10% in that and not 2%. But that's not good portfolio management. So that's what I would suggest, is actually just try and look at the world in terms of this bifurcation that's taking place. When you're buying a particular company, and look, the sectors are easy. It's commodities, it's precious metals, energy. Across the energy spectrum, you're littered with choice: oil and gas, uranium, coal. Coal is just wonderful. I mean, it's like still people aren't paying attention to it.
I know.
And
I know.
and we've been killing it on coal, and it's still cheap. So, but anyways, agriculture, fertilizer stocks, shipping. Shipping, I think, is going to become quite important too, for a number of reasons. One in particular that I'm looking at is if you look at a lot of the, and shipping, of course, you've got dry bulk and you've got container ships, and there's a number of different sectors. But by and large, if you think about shipping, it's a capital intensive business. It's been decimated for the last roughly 10 years. A lot of the shipyards are shut down. So the supply is difficult to bring on board. Financing it is difficult, right? Because it's deemed to be carbon emitting and all of this sort of stuff. But here's what I think happens, because a lot of these companies have gone bankrupt, right? Already gone through bankruptcies. The debt holders became equity holders. They've been wiped out, and they're sitting there and they're pretty much the best that they've looked in a long time. Now, think about this. Let's just say you and I owned a couple of ships, $100 million ships. Congratulations, we're rich. So we got like $200 million worth of ships. And they were 200 million in 2019. Okay. And now we want to bring another one on board. It's not going to cost us $100 million anymore, because the cost of aluminium, the cost of steel, all of these costs, as well as labor costs, have gone up substantially. Yeah. So it's not $100 million ship anymore. It's maybe 120, maybe 150. It's some other value, and it's higher, not lower. Okay. And the book value of these companies has not yet reflected that in many instances. Then you've got the cash flow. So that's your balance sheet. Then you've got the cash flow side of things. And that inability, that lack of supply, right, is one thing. So now where there's a need to move goods around the world, those day rates are climbing. Then we've got the politicians coming out saying, no, you're emitting too much carbon. So now you've got to actually run your ships. You either have to run them with a certain fuel type. And what a lot of the ship owners have told me is they're just going to run them lower in terms of speed. So instead of, like, what's it, 60 knots or something, goes to 30 or something. I can't remember the actual values, but basically they run them at half the speed. Yeah. But now it's going to take you.
By the way, creates more shortages of stuff at the grocery store.
Yeah, of course. But now you're running them for twice as long. So all of those dynamics, basically, you're just going to see more shortages. And with more shortages, the price, that income stream, the nominal value goes up.
Right.
And still your book value remains. So now let's quickly go back and think about the debt repudiation we discussed. You have debt repudiation. What do you want to own? You want to own stuff. You want to own something that has productive value to it. So fine, you might say, I'll go and buy gold. But what are you going to do with the gold? Well, you want to trade gold at some point for stuff. How do you get the stuff? Well, it comes on a ship quite often. So like you run through these sort of supply chains, that's kind of an interesting one, and it hasn't moved a whole lot. Dry bulk's done okay for us, but wet shippers and tankers are still pretty shitty. But it's just something for folks to think about. Book value of these assets is going to become more valuable, more interesting. People will start looking at it and go, hey, I can buy a company that's got 10 ships. And you know, in 2019, the book value of them was, I don't know, $2 billion. But we can't get $2 billion worth of ships. Like, I could not go out and get $2 billion of ships like that. They're not worth $2, they're worth $4.
Yeah. But I think that the main lesson there, Chris, in hearing you think through that out loud, is that it all goes back to the basics of supply and demand. You've got to focus on that. Forget trying to get a hot tip with a ticker or anything like that. Just think through what's happening in the world today through the standpoint of supply and demand. It's exactly what Jim Rogers talked about in Hot Commodities in 2004. just whether back then he was talking about lead, he was talking about sugar, which, by the way, I think coal today is what lead was in 2004. I mean, it's viewed the exact same way. And by the way, when Rogers wrote the book, lead was trading at about 500 per ton. And look at a chart, within the next 2 or 3 years, it went to $3,500. And this is at a time when demand was decreasing rapidly because no one wanted to touch lead. Because you're my age, so you remember back then, lead was the evil. Lead was Satan. It was causing little kids to be poisoned in their bloodstream, and everyone wanted to take it off the paint off their walls and everything, take it out of gas and all this stuff. And so everyone thought that was the worst investment. In fact, that was quote unquote uninvestable. But what happened, of course, is demand stayed pretty consistent, went down a little bit, but supply just absolutely plummeted. And I think it's the same thing with coal today. So that's really the main takeaway here, guys. If Chris is going to give you any insight, it's to think through things from a standpoint of portfolio construction, risk management from a geopolitical standpoint, and then just go back to the basics of supply and demand.
Yeah, it's complex, but it's not, it's actually simple. It is quite simple, and a lot of people get caught up in sort of jargon and financial terminology and so on and so forth. You don't need that. You just need a logical brain. Just like you can sit down, look at the aggregate numbers, and I guarantee you can do better than 90% of the people sitting on CNBC listening to Kramer.
Yeah, exactly. All right, but I know we've gone over an hour. I want to remind everybody to check out Rebel Capitalist Pro. You can do that. You can get a $1, week trial subscription. And this is the online investment forum that I have with Chris MacIntosh, with Lynn Alden, Brent Johnson, Tony Greer, Patrick Sresna, Jason Hartman. And we all do live streams on there for the members. It's just an incredible online resource. So check that out at georgegammon.com/pro. And Chris, for the viewers and listeners who want to find out more about what you do, where can they go? What's your website or Twitter handle?
So website is capitalistexploits.at, although .com will take you there as well. Twitter handle is capitalistexp. You can find me there. Yeah.
All right, buddy. Thank you for your time. I always enjoy these conversations.
Likewise, it's been fantastic. Appreciate it. Thanks so much.
All right, we'll talk to you soon.
And best of luck to all.
Hello, fellow Rebel Capitalists. Do you enjoy watching these interviews I do for the Rebel Capitalist Show? Well, if so, you would absolutely love Rebel Capitalist Live. This is the conference I do twice per year, and we've had speakers like Robert Kiyosaki, Lynn Alden, Rick Rule, Jeff Snyder, and Dr. Ron Paul, just to name a few. So go to rebelcapitalistlive.com and check out the next event we have scheduled in Miami.